The tech sector is doing really well this year with a 45% gain. Communication and consumer companies are also doing all right. People have jobs and are spending money, so investors are looking for companies that are making good money, have low debt, and are just solid overall. Here are our top 5 stocks to buy and hold for 6 months to make some good money. A little while back, we told our viewers to consider Super Microcomputer Inc. stock when it was around $120. Some folks said it's already too expensive because it's at its highest price in a year. But guess what? It's now trading at over $300, up more than 200%. So just because a stock has a high price doesn't mean it's a bad deal. You see, good companies keep growing and their stock prices go up. The tricky part is finding these good companies. That's where we come in. We look for companies with a great track record and lots of potential for growth in the future. Here are a few examples. We suggested buying this stock when it was around $400, and now it's over $500. There was also this penny stock trading at around 50 cents, and it's gone up a whopping 300%. Big shout out to Seeking Alpha for sponsoring our video, and its analytics. Make sure to get your 14-day free trial of Seeking Alpha. Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. Now, let's talk about some stocks you might want to consider. First up, we have Alphabet Inc. You probably know it as Google. This is a stock you buy and pretty much never sell. Google's services are used by billions of people every day, and they're a part of our daily lives. While the stock price had a rough time in the last year and a half, Google's revenues kept going up as more people went digital. Those who kept buying Google shares have basically doubled their investment in just the last 6 months. Google is famous for things like Google Chrome, the Android smartphone platform, and YouTube. They're also making a lot of money, with nearly $90 billion in cash from their operations, profit margins of over 55%, and a net income margin that's way above most companies at over 600%. Just like Meta, formerly Facebook, Google has been a leader in tech and platforms. They recently launched a chatbot called Bart in Europe and Brazil, and that alone bumped up their stock by almost 5%. They're taking advantage of the growing demand for artificial intelligence solutions. Despite some challenges, Google is doing great with advertising revenue and strong subscription growth. They have around 50 billion daily viewers on YouTube. In 2023, they even beat their earnings estimates for the first quarter. Their forward PEG ratio shows they might be a bit pricey compared to other companies in their sector. But with their strong cash flow, subscriptions, and ad revenue, Google is well set for long-term growth. With a market capitalization of $5.74 billion, it's a strong buy. Next on our list is Meta Platforms Inc., previously known as Facebook. They're getting into the game with Threads, a competitor to Twitter. Threads has taken off like a rocket, with over 100 million sign-ups since its launch in July and more than 150 million downloads. It's becoming a major player in the social media world. As part of Meta's family of apps, Threads is connecting people worldwide through tech devices, contributing to the company's impressive profitability and growth. Meta's stock has been on fire, surging more than 133% this year, making it one of the stars of its sector and industry. Threads has gathered a substantial user base, which is a golden opportunity for Meta to increase its ad revenue per user, as advertisers want to cash in on the platform's popularity. Meta's expertise in pioneering artificial intelligence and its array of traditional products have also played a significant role in driving profitability and user engagement, boosting its ad revenue. In fact, Meta's earnings per share (EPS) of $2.20 beat expectations by a solid 25 cents, and its revenue of $28.65 billion exceeded estimates by nearly $1 billion. However, it's worth noting that Meta's valuation is quite high, with a forward PE ratio 41% higher than the sector average. But when you consider its substantial growth potential, Meta's forward PEG ratio, which adjusts for growth, stands at 1.34x, a more attractive figure compared to the sector's 1.52x. That's a difference of over 11%. Despite some challenges such as privacy concerns and declines in user traffic and ad revenue, Meta has a vast network, a hefty $50 billion in cash reserves, and an innovative approach that positions it for more top-line growth. With the success of Threads and Meta's continuous advancements in AI and technology, the company is set to stay dominant in the tech industry. In short, it's a strong buy with a market capitalization of $754.11 billion. Now, let's talk about Axillus Technologies, Inc., ticker symbol ACLS on the NASDAQ. This company has made a name for itself as a top-performing semiconductor equipment firm, showing resilience even in the face of economic challenges and industry ups and downs, especially in the IT sector. Axillus specializes in designing, manufacturing, and servicing highly precise ion implantation platforms used in semiconductor fabrication. It's riding the wave of increasing demand for digitization and electric vehicles, helping chip makers improve yield quality while cutting costs. This has driven a significant uptick in the company's shares, with a year-to-date increase of 123% and an impressive 173% surge over the past year. With a growing network, strong earnings, and robust growth, Axillus Technologies reported fantastic first-quarter results. They beat expectations with an EPS of $1.43, which was 13 cents more than estimates, and revenue of $254.02 million, marking nearly a 25% year-over-year increase. Despite its strong performance, Axillus Technologies is currently undervalued, boasting a forward PEG ratio of 1.34x, which looks very attractive when compared to the sector median at 1.94x. Moreover, the company set an all-time high backlog record of $1.27 billion, and this was mainly driven by the strong performance of its Purion product family. This impressive feat solidifies Axillus's position as a significant player in the semiconductor equipment market. Mary Puma, the CEO and president of Axillus, expressed, and I quote, "At the beginning of this year, we expected 2023 revenue to exceed $1 billion. We're now projecting to surpass that estimate by $30 million, reaching $1.03 billion. This represents approximately 12% revenue growth in a year, when overall wafer fab equipment is expected to decrease by over 20% in the second half. In addition to stronger revenues, we anticipate significant margin expansion due to a favorable product mix and improved costs. The mature process technology market remains a strong area for us, with 89% of first-quarter system shipments going to mature foundry logic customers and 11% to memory customers, all of which is composed entirely of DRAM. In summary, it's a strong buy with a market capitalization of $5.74 billion. Now let's talk about Extreme Networks, Inc., ticker symbol XSTAR. This company has been on an impressive growth streak, with a year-to-date increase of 46% and a remarkable 150% surge over the past year. This surge was further fueled by the positive remarks of Oppenheimer senior analyst Timothy Horan, who stated that Extreme Networks is well-positioned to benefit from the shift towards cloud computing and AI. This endorsement led to a 7.5% increase in the stock's value. Extreme Networks is offering an attractive investment opportunity with an appealing valuation grade of C+ and a forward PEG ratio that shows a 35% discount compared to its sector peers. The company's new CFO has added to its growth prospects as it consistently outperformed earnings expectations. In its recent third-quarter earnings report, Extreme Networks surpassed expectations with an EPS of 29 cents, beating estimates by 3 cents, and reported revenue of $332.51 million, marking a significant 16% year-over-year growth. Due to these robust financials, the company has seen 6 upward analyst revisions in the last 90 days with no downward revisions. With minimal debt and strong momentum, Extreme Networks achieved a record $39 million in non-GAAP net income, while witnessing nearly 30% year-over-year growth in new software-as-a-service subscription bookings. The company's profitability and cash generation also reached record levels. Furthermore, Its outstanding operating margins and adjusted EBITDA of $57 million enabled Extreme Networks to repurchase 1.4 million shares for $25 million, showcasing its commitment to returning value to shareholders. Now let's take a look at MI Homes, Inc., ticker symbol MHO. MI Homes is a well-known single-family home builder with a strong presence in various parts of the United States. Their main focus is on financial stability and constructing affordable communities, which made up 50% of their recent quarter sales. This strategy paid off, leading to an impressive Q1 EPS of 3.64 cents, beating estimates by a substantial $1.28 and revenue of $1 billion, marking a remarkable 16.23% year-over-year growth. Even in a rapidly changing market, Michigan Homes has demonstrated solid growth over the past year. As financial and economic conditions continue to improve, Michigan Homes' new contracts and inventory backlog resulted in a record-breaking quarterly net income of 12% in the first quarter, totaling $103 million. The boost in revenue came from a 10% increase in closings and a 6% rise in the average sale price, which saw a significant 16% surge, leading to a Q1 revenue milestone of $1 billion. These stellar financial results validate MI Homes' strong buy rating. The company's exceptional performance, with double and triple-digit price increases over the years, showcases its robust fundamentals and growth potential. MI Homes' dedication to financial strength and providing affordable housing solutions has positioned it favorably in the market, allowing it to achieve remarkable success and maintain a strong buy rating. With a market capitalization of $2.54 billion, Michigan Homes, Inc., along with Green Brick Partners, Inc., has shown exceptional performance in the home building industry, with both companies recording significant gains of 100% and 115%, respectively, over the last year. Despite the real estate sector facing some difficulties, there are positive trends in segments like home building, which have contributed to the success of companies like MI Homes and Green Brick Partners. These stocks are currently undervalued and have strong upward momentum. This is indicated by their PEG ratios, which suggest they are trading at substantial discounts compared to other companies in their sectors. MI Homes, for instance, has a trailing PEG ratio of 0.17x, indicating a significant 75% discount. On the other hand, Green Brick Partners has a forward PEG ratio of 0.15x, representing an impressive 89% discount. So these stocks present great buying opportunities. In summary, these top 5 stocks for the second half of 2023 offer a compelling mix of growth potential, solid fundamentals, and innovation across various sectors. These companies have shown resilience even in challenging market conditions and have benefited from emerging trends like cloud computing, AI, and home building. As the economy continues to recover and industries adapt to changing dynamics, these stocks are well positioned to keep moving upwards, providing value to shareholders and promising a successful second half of 2023.